Welcome back to a special show for us. We are broadcasting live in Orlando from The Money Show. I'm Jim Iuorio. That's Bob Iaccino. You probably know who the guy is in the middle, one of our dear friends, Kenny Polcari, the chief strategist of Slate Stone Wealth Management.
Yes.
Did I get it? Okay.
Jupiter, Florida. Yes, you
a lot
did.
Of words. Okay.
Yes, you did.
Thank you for joining us.
It's always a pleasure. I love doing this with you guys.
How long ago did you move to Florida?
I moved here in 2019, so what's it, 5 years ago, going on 6.
No regrets?
You know, I don't have any regrets because, remember, my life changed dramatically because the floor of the New York Stock Exchange changed. I spent 40 years in New York because of the New York Stock Exchange. I lived and breathed the place. But, you know, technology changed the look of the whole place. The 5,500 people that work there are gone. There's less than 100 people that work there. And so I miss what I had. Right? But I have to tell you something. Life in Florida is not so bad. I could be living in a lot worse places. It's not a third world country by any stretch. I live in North Palm Beach and have been very happy.
So, but you Bobby, moved to Florida too. By the way, I'm a Chicagoan, born and raised, and I'm planning on putting the lights out, although these guys make compelling arguments. When I say no regrets, I regret buying one pack of gum and not the other at the grocery store. There's some regrets.
But you're also like that. You're very much like that.
Yeah.
We talked about this before. I have tattoos, he doesn't.
Right.
And he said to me, you know what, I don't have any tattoos because I'd regret them 5 minutes after I got them.
After I got them.
Where do you have them?
All over. It's not even worth the conversation. But no, I mean, I'm down here 4 years now, living in Florida, and I always tell people that I miss what Chicago was.
Right. That's what I miss.
And a lot of it has to do with the trading floor, to be honest.
Right.
Like the trading floor, the crime wasn't where it was. You could walk around at night, this and that. And I lived in the city in downtown Chicago. So I actually really, really loved it. I still call it home. One of my tattoos is a Chicago flag.
Yeah.
Still home to me, but I would never go back.
It's funny because I'm actually a Bostonian, right? I was born in Boston. I lived there until I was 22. I moved to New York when I graduated college. And then I lived in New York for 38 years. I met my wife there. My kids grew up there. So my life, my adult life was really in New York. I love New York. In the 80s and 90s, early 2000s, New York was great. The job was great. Everything was great. But then the world changed. 9/11 changed the world on so many levels. But from my perspective, it changed the job that I did dramatically, and so that job no longer exists. So when you say, do you have any regrets? I have regrets that all that happened.
Yeah, I wish that stuff wouldn't
I'm almost
change.
sad, right? I'm sad that all that happened.
So it's funny because I was just thinking as you were saying it, because in 1998, let's say in Chicago, like the futures industry employed 400,000 people. Like New York has Wall Street, but also has fashion. It has legal. It has all these big industries. In Chicago in 1998, we were at the top of the heap.
Yeah,
people knew us where we went. All the it was a nice time, wasn't it?
It was. I mean, people would be like, there go the guy in the coats. You know what those guys do?
Yeah, right.
You know what's really interesting is that when I was a freshman in college, I had the opportunity to potentially go and work on the Chicago. Instead of going to New York, I could have gone to Chicago. And there was a family in Chicago that were going away to Europe for the summer, and I was supposed to house sit their home right in Chicago. It was a brownstone in Chicago.
Oh, nice.
It would have been absolutely stunning. And I would have really, and who knows, the course of my life could have changed dramatically. But as it turned out, they ended up having to cancel that trip. And so the opportunity went away, and I ended up going to New York. And then that changed my life.
Yeah.
So it was very interesting. But had I ever gone to Chicago in 1980, who knows?
Who knows?
We could have been like best buddies.
Oh, yeah, we are now, I thought. Okay, I guess we're not. Anyway, we would like to talk about markets on occasion. I know you know that. Okay.
Yeah.
So we've had we've taped a couple other segments today and some interesting themes coming up. You are aware that there is, I think it's an election in like 3 weeks.
Do you think? Yes.
You read about that somewhere?
Yes, I've heard about it.
I do want to get everyone who's come on for these segments to tell me what you think significant implications. We don't talk about politics. We do talk about policy. Policy is important. What significant implications from policies that could be coming down the pipe?
Well, so listen, from the Republican side, I think the policy is going to all be about less regulation, right? He's going to there's going to be talk on less regulation and trying to free up the red tape, which I actually think is a good thing because I think there's way too much red tape. And I think when the other side wants to prevent stuff from happening, they'll say they're not fracking is a perfect example. Oh, I'm not I'm not saying we can't do fracking, but they're going to put up so much red tape it's impossible to do it.
Yep.
So yes, she could say, no, you can still frack, except you can't get through the paperwork. On the other side, on the Republican side, they'll get rid of a lot of that stuff to kind of ease up the process and hopefully help the economy grow. Obviously, we're going to talk about tax cuts versus no tax cuts, or who's going to get those tax cuts. I do think. If you go back and you look at the Trump tax cuts when they first happened, this whole argument that they just went to the upper crust, I think is completely wrong.
It's bullshit. It's wrong.
Because I wasn't the upper crust and I benefited from those tax cuts, right?
By the way, I wouldn't even argue even if they did, but they just didn't.
But they didn't.
Right.
But they didn't.
Yeah.
On the other side, what I'm really worried about, and actually on both sides, I'm really worried about the spending implications, because both of them have promised to spend more money.
No doubt.
And as we get closer to the election, it's like they're just grabbing for anything new to spend. And that concerns me just a little bit.
Do you think part of what we're seeing now is a Trump trade?
Yes.
So do I.
I think what we're seeing in the market is a Trump win. I don't necessarily think it's a Republican win.
No.
I think it's a Trump win. So at this point, all I want is I want there to be a split Congress, because no matter who's in the White House, because then it's going to stop the right from going way far right. It's going to stop the left from going way far right.
Yeah,
left.
we want them to do nothing.
And the market actually prefers when there's gridlock, because the normal people have to come to the middle then and get stuff done. Right. The people on the fridges get eliminated, which I think is perfectly okay.
Perfect.
For the record, and I said this when we were talking to, I believe, Stephen Moore, that for anyone who doesn't believe what Kenny and Jim said about how it benefited everyone, Trump tax cuts, go into Google or DuckDuckGo or Yahoo, whatever you use, Bing, and type in New York Times, face it, you probably got a tax cut. The New York Times wrote an article in 2019 that explained to everybody that somewhere in the range of 97% of the working population got a tax cut.
And those other 3% don't pay any taxes.
For the rich.
Right.
Yeah.
Right.
It wasn't just for the rich. I just want to get that out on the record.
Okay, so we should actually put the hyperlink somewhere to that, because
that's a good idea.
Someone on the left doesn't seem to think that happened.
No, it actually did happen.
It did happen.
So to the point of looking back at the old Trump presidency, 2016 to 2020, and the new one of the things that I brought up to Stephen Moore was that I thought it was more impressive from 2016 to, let's just say, 19, because of the pandemic, to take a bull market that was about 8 years old, 9 years old, and add another 3 years onto that, because we all know bull market cycles, 8 to 10 years approximately. Well, now he's going into one that's, can we call it 3 years old, 4 years old, 2 years old? It's young, right? Do you think that the policies that we're aware of make any difference in a young bull market or an old bull market? Or is it just markets are markets and this will be good?
In the long term, I think markets are markets. I think markets end up flushing out what it needs to flush out. I do believe in that efficient market theory that, in the end, they'll flush it out. I'm bullish on the long term. I kind of thought we were going to have some volatility here in the short term, which is this time of year, which is seasonally weak. I'm surprised we haven't, but I'm surprised we haven't, but I'm not surprised we haven't, because I think the Fed has gone out of their way to prevent really any pullback in the market in weeks ahead of this chaotic election. So I think, is there the possibility after there's an election that maybe there's a little bit more volatility, that maybe the Fed, after the election, the Fed steps back and lets the market kind of trade as it should? But we'll see. I'm a little bit nervous no matter which way happens, because unless it's a decisive win by one side or the other, it's going to get challenged on either side. If he wins by a small margin, they're going to challenge it. If she wins by a small margin, they're going to challenge it. And we're going to be in this state of limbo.
Okay, I want to ask about certain sectors, but I will say something. I was on a podcast the other day, and it was a viewer question, said, is this like the craziest time you think there's ever been? I was like, dude, in the late 1960s, 5 of the leaders of the left were shot and killed. In the 1860s, everybody picked up guns and started killing each other across field. So at the very most, it's third most crazy. So we've been here before.
Yeah.
But anyway, let's talk about, so is there, when you look at a particular president, I've heard some say that a Harris president, Democrats in general, favor big tech. There's been lots of rumor of even unholy alliances with big tech and certain sides of the aisle. Trump presidency might be better for the oil companies, although the price of oil could go down. The question, long-winded question, mostly because I just like hearing myself talk, is there specific sectors that do you think benefit from certain presidents, and what are they?
Well, no, so certainly on the Republican side, I think oil is going to benefit. I just do think, even though the price of it may go down, I don't think demand's going away at all.
Yeah.
And I don't think U.S. demand or even global demand's going away. Right. I think that nuclear is going to actually become very important.
You saw the headline today, right?
You saw the headline today.
Yeah.
I think that's going to become very important. I think certainly the AI tech trade is always going to be important, no matter which side wins. I think that's just the way the world is going, right? On the other side, what I'm worried about on the other side is that tech, that they're trying to just break it all up. That's what I'm worried about on the other side. I don't think the Republicans want to break up tech as much as the Democrats want to break up tech, right? And they want to get their hands in there.
I think it's talk personally, but
well, it might be talk, but look, they broke up AT&T, right?
Yeah,
remember that?
Right. Yeah.
We were then. They broke up AT&T, and so the Google thing. I mean, yes, they're talking about it, but there's a real conversation happening about breaking up Google, right? Whether or not I agree with that or not, I don't own Google, so.
I have lots of very deep-seated opinions about Google.
Yeah, go ahead.
I don't know if I'm going to get shot or no. Is there snipers anywhere? I
don't see any.
To say that the government is involved in Google, I think is an understatement.
Yeah.
I think they've been involved from the
100%,
beginning.
100%.
I think you can actually make the argument that Google is the government.
Yeah.
Robert?
So Kenny, you've had a long career, and if somebody said to me, "What's Kenny known for?" and I would say it's kind of his gut, like his ability to look at a market and go, "I've seen this before."
Yeah.
Right?
Yeah.
Have you seen what we're in before? And I'm pointing specifically to stocks and gold reaching all-time highs at the same time.
No. So actually, something, I don't remember if gold reacted the same way that stocks were reacting back in the height of the 80s and 90s when the birth of the greatest bull market we've seen. I'd have to go back and look at those charts again in gold because I wasn't really paying attention to gold then.
Neither was I. So
I was so involved in the equity market and the excitement around the equity market during that whole 25-year bull run, which was really amazing in the 80s and the 90s, right? Certainly after the market crash in '87, and then what happened as we moved into Y2K and all the excitement around tech.
Yeah.
But I don't know the answer to that question because I wasn't that focused on commodities or gold at that time. Mm-hmm. Today, I do a lot. In the note that I write, I try to hit a little bit on everything. Gold and oil is part of the broad conversation I have in my daily blog about stocks and bonds and gold and different commodities. But no, I haven't. But I think the move in gold, I think most recently is part of a safety trade because I think people get nervous. But I also think that there's a bunch of central banks, because they made it clear maybe 2 weeks ago, there were a bunch of central banks that said they plan on increasing their gold reserves. That put an immediate floor under gold.
Biggest amount in 75 years.
The biggest amount in 75 years. So I think that's part of the reason. But I also do think that this recent push now is a safety trade. I think people are getting really nervous about what happens in a couple of weeks. I think they're nervous about what happens outside of the election, right? Violence, potentially.
Sure. Oh, yeah.
I think that's what people are nervous about. Okay. I mean, listen, I'll be the first one to say, I'm nervous about that because I think if he wins, then there's going to be, there's going to be trouble on the left. If she wins, there'll be trouble on the right. Although I think, and I hate to say it, but I think the trouble on the left will be more significant.
Well, it has been.
Because we've seen it.
Yeah.
We've seen it.
Right. And it was bad.
They were burning down the big cities, and that's my fear.
And by the way, they were burning down the big cities, being cheered on. That was the weirdest time in my entire life.
Completely.
Being cheered on by the government.
Completely.
I don't understand. A lot of people, businesses you can replace. No, you can't.
No, you can't.
A little bodega on a street corner. No. They're not going to replace that shit. That's absolutely absurd. There's something I want to hit on though. I don't know if of course you did. Everyone would read my Substack from 2 weeks ago about Mike. Just to refresh your memory on, it was my contention is that you can look at stocks over the last 3.5 years and say they've gone up 54%, gold up 45%. Silver up 35%, all these things up. I say, no, they're not. The dollar's just lost 30% of its value.
Right.
Which, by the way, knowing that only matters in one respect, in that it indicates to me that bubbles don't exist out there because bubbles are not about absolute price. Bubbles are about speculative fervor and weak-hand buildup, margin.
Yeah.
So you agree there's no bubbles anywhere, right? Yeah, we're opinion people. We can be wrong.
No. I
Second
disagree.
you say there's not.
Yeah. No, I disagree. I think there is a bubble that's building.
In what?
I definitely think there's a bubble that's building in stocks. I think we're way stretched. We haven't been able to come back. We haven't been able to kind of shake the branches a little bit, test lower. I think there is a bubble in stocks, and I don't think it's going to be a disaster, but I think there is a bubble.
But you would at least give me that you need a lot of leverage to have the bubble really burst hard.
Correct.
Okay, Bobby.
Do you see it do you see it in a sector, or you see it in the market at large?
I see it in the broad market, but I absolutely see it. I think tech is certainly stretched, way stretched. Sure. I think that's the one that's the one that when it adjusts, I think you'll see certainly plenty of money come up because it's so stretched and it's an overcrowded trade. Everybody's in it. And you saw what happened the other day when ASML came out with that miss, when they announced the miss on it. They took the whole sector down right away. NVIDIA, all these other names, they took them right down. I actually had a client that got so nervous, wanted to sell everything. I'm like, slow down. Just slow down. And now look at this. Then TSMC comes out yesterday and blows the doors off the place. And guess what? TSMC is ASML's biggest customer. So it's confusing that ASML says on one hand, we see a slowdown, but TSMC says business is so good, we're blowing the roof off the house. So there's a disconnect there somewhere, right, between the two.
Yeah, but there always is, which is fascinating to me. Yeah.
What do you guys do at Slaystone, and you specifically? So if somebody calls you up, says, "I just enjoy Kenny and I want to work with you," what deal are they getting into?
So we're a wealth manager. We're fiduciary. We're a long-term wealth manager. We're not a broker. We're not a trading firm. I'm the chief market strategist, so I represent them out at conferences. I represent them in the media. I represent them out at corporate events, client events. I also sit on the investment committee, so I plan. We rehash and create the portfolios. I'll sit on individual client portfolios if we're designing a specific bespoke client portfolio for somebody. I'll sit on those. But mostly what I do is I represent them out to the marketplace, right? Via different.
So I assume your clients are relatively high net worth.
So the clients are high net worth. Yeah, it's $1 million minimum and up, right? So the clients are high net worth and ultra high net worth, and but it's a very traditional long-term wealth management plan. There's not all these complicated bells and whistles.
Yeah.
We're long only. We don't play from the short side. It's very, very methodical. And we're very methodical in not only how we pick our stocks and pick the portfolios, but then how we then put new money to work, right? We're not chasing things at all. We're very patient, wait for them to come back. Things like ASML provided a great opportunity. It's down 35% off its high. That's a huge opportunity. And so we took full advantage of that for clients that are in it, right? And so that's what it is. It's very traditional. We offer all the certainly the accounting and the trust services and the estate services and all that stuff like any good fiduciary is going to offer. And our headquarters is in Jupiter. We've got a group out in Madison, Wisconsin. We have a couple of analysts up in New York, and we've got another satellite office in Western Florida.
So is the 60-40 model dead?
I don't think the 60-40 model is dead, but I don't think the 60-40 model works for everybody at all. I think you have to be really, really sensitive to. Again, it goes down to who you are, what's your risk level, where you are in your life cycle. Right? What are you really planning for? Are you planning for this money for you and your wife? Or do you have so much of it that the money we're talking about is for your grandchildren and that's another 50 years out? So that's a whole different risk model. So the 60-40 model doesn't work for that at all.
Beautiful. I agree.
It's interesting. I know a 77-year-old guy who, he asked me to look at his portfolio, and I said, look, I'm not an advisor, but I could tell you what I think is happening in the couple of sectors you represent. And he goes, well, this isn't really my money, it's my daughter's, so I'm not worried about he doesn't need the money.
It's not for him.
So he's like, it's for her, so we want to stay aggressive.
Right. So it changes the conversation. That's why when someone says to me, what do you tell clients? Well, you don't tell clients. I mean, you can broadly talk about what the market feels like, but I'm not telling you the same thing I'm telling him with your portfolio versus his, because you're 60 years old, he's 40 years old, you got 3 kids, he's got no kids, whatever it is.
Pretty accurate on both things.
The age thing I totally challenged. The kids thing was right.
But what I mean, it's a different conversation, right? And that was one of the things I spoke about today, even in my presentation, was that you have to know who you're talking to.
Yeah,
I was hoping to go into his office someday because being worth hundreds of dollars, I wanted to get help with,
You can come to my office. We're over in Jupiter. Come right over.
I'm worth hundreds and hundreds of dollars.
She got out of school, 9-10 years ago. I set up all her stuff, and it was every 100% in growth.
Yeah.
And now she shows me her portfolio. It's 10 years later. I'm like, whoa, we got to be a little more conservative now. Not a lot more conservative, but
no, right.
Everything just isn't intact.
Right, correct.
Now, so she's like, oh, okay, that makes sense. So it's good timing, though.
It's funny, I did the same thing with my younger daughter because, when she was younger, I had it all in growth and tech and stuff like that. But she's gotten older. She's 34 years old, but. Now, I said to her, we need to start to diversify this out. Not go bonds, not go conservative, just you got to start to diversify it out. Get it, you can't have 100% in tech.
Right.
You just can't, it's dumb.
This may be like too specific of a question because, again, it might go to who you're talking to, but do you guys put more weight in you've made this much so we need to rebalance, or you're at this age so you need to rebalance, or a mix?
So it's really a mix, right? Because you're going to rebalance for a number of reasons. You're going to be rebalanced because of their age, so you're going to rebalance. You're going to move from stocks maybe into more fixed income, so rebalance that way, versus just taking a portfolio of stocks that have gotten out of balance because price increases, and then you want to rebalance that way, right? So again, it depends on who you're talking to and what the portfolio looks like, right? In terms of rebalancing. The other way, like the way I rebalance my own portfolio is when I'm adding new money to it. If tech has now become overweight in portfolio, I'm not buying any more tech. I'm going to buy the ones that have underperformed. So I haven't sold my tech.
No. Yeah.
I've just added money to this underperforming. So now I've rebalanced it because now I've added more money here, so that brings that percentage down.
So Kilberg's firm they do like collars for people who have a lot of one stock who call him.
Yeah.
You don't do stuff like that, right?
Yes, well, if you're like concentrated positions, yeah. So if they're concentrated positions, yes. Well, if you're married to that concentrated position, we will absolutely work with you around protecting.
What we're talking about here is like someone who my cousin worked for a consulting firm. He's got just a metric boatload of he doesn't want to take tax want to take tax consequences on it, so he's looking for a strategy. Right,
but you see, there's another problem with that because again, we've heard all the stories, all these people that did the same thing with Enron or Bear Stearns or Lehman Brothers. They loved it. Even they might have had calls around it, but when they went belly up, they went belly up.
Right.
And so there is a conversation to have about somewhat diversifying. You got to be smart too, right? So if that means you have a capital gains issue, but you're being smart about it, I think you really have to consider that, especially if you're so overweight, or if you work at this firm and then your whole wealth is involved in this firm.
Right.
I think you have to think about diversifying away from some of it.
Okay, let's talk about the tax policies of the two different candidates. Policies, not politics. Don't give me that look. Politics. Policy. The tax policies are disparate. That's the word.
Sure.
The one, in my opinion, the one from the left seems like 2 levels below asinine.
I'm not even
that's
sure.
That's the right answer. Not even any words.
Right. Right. I'm not even sure who in their right mind could even suggest a policy like that. Where do these people, these advisors, where do they go to school? Are they going to Harvard and Yale and Stanford?
Probably.
Okay, but then
that's the problem.
But wait, but on the other side, then they're going to Harvard, Yale, and Stanford too. So they're learning. How could they come up with 2 separate? If they go into the same place and they're learning the same thing, how can you say the sky is blue and you say the sky is green when it's,
Because I have an answer for that, by the way.
Yeah, so do I.
If the plan is just to stick it to people and the fallout doesn't matter.
Yeah.
What do you think?
I think 2 things. Number one, if the plan is to remain in power, then you're just buying votes.
Okay.
It was de Tocqueville that talked about that, right? But also, if the plan is, if you surround yourself with other academics, I have no problem with Yale or Harvard or any of those guys if they worked.
Right.
But if they went right into academia or right into politics, one
and they have
side,
no experience.
Exactly.
No real world experience.
No real world experience.
Right. I hear you. Right. They go right into academics.
At least bring somebody on your staff that sees things differently than you and have actual conversations internally.
But this whole idea about taxing unrealized gains, how does that even get off the table?
Because it sounds so good to the pitchfork villagers.
You also have to remember too, when they say, and it's only going to affect people that make more than $400,000
What
with
about
inflation.
the farmer that owns all the land up there that's worth $40 million this year? Now next year it's worth $60 million.
Agreed. And
you owe me tax on $20 million?
Agreed. And that particular, when they say that, the thing I think to them is imagine what $40,000 was 20 years ago.
100%.
They may never move that level,
right.
but your barista is going to be making $400,000 if they keep printing.
Correct.
Most of those cash machines, you still can only take $300 out.
Right.
That's what you could take out 25 years ago.
Right.
They never know, and they're not even government. Government never moves any threshold.
Asinine.
Right.
But
by the way, and I just paid $8 fee. I didn't go to the bank.
Jones.
I went to one of those ATMs. It used to be $3. Now it was $8, but I'm here and I'm stuck. Right? So I got to do it. But
I mean, Vegas when you need money for the
that's I think in Vegas, I think it's $20.
Yeah,
I spent $20 in gas to not pay that fee.
Really?
Yeah.
Yeah, I'll drive 3.5 hours from here just to go to like one of my banks.
Just to stop so
not
pay the
that
$8 fee.
It's just the principle.
Can I ask you real quick about thoughts about oil? Candidates' relationship to oil, or do we already talk about this? So we've done 4 in a row.
Yeah, we talked to somebody else about it.
Okay, what do you think about oil?
I like oil. I'm long oil. I don't think oil is going to collapse. I think even if Trump wins and we start to produce more oil, become the swing producer like we actually were, like we were when he was president, I think global demand is going to remain strong. I just do.
Yeah.
I think that everywhere you look around, you look at the demands that AI and technology have on the grid and on energy, on electricity demand. Where's that coming from? It's not coming from wind and solar.
Yep.
Some of it might be, but the bulk of it is not coming from wind and solar. So fossil fuels, I don't think are going away.
Agreed.
Right? So I happen to like energy and I like oil. The biggest names certainly ExxonMobil, like that, and they're huge dividend pays. It's the mega name in the space. Where's it going?
Kenny said something real important there that hasn't been said on any of the interviews we've done. We used to be the swing producer. The swing producer is more important than the largest producer.
Right.
And that has to do with CapEx over time. Because I wrote a Substack that nobody read, and it was about the lead time for when you allow leases to go up for auction, and then you explore those leases, and 70% of them are garbage, and then you go get other ones, and then you drill some exploratory holes, and then you do the fracking, which in and of itself takes 6 to 8 months to get done. You're talking anywhere from 24 to 36 months before you see a drop of oil, and our rig counts have been declining, and now the production is starting to follow. So rig counts in the U.S. lead production by about 18 months. So you're talking about a net of about 4.5 years, even if Trump goes drill baby drill, for that oil to hit the markets.
So in that time, crude may stay relatively elevated because of supply issues.
Yeah.
But the integrateds could do even better because of less regulatory.
Yes.
Less
Less
regulation.
regulation.
That's interesting because I'm trying to fashion a trade, a Trump oil trade, but I haven't worked out.
But also, as much as people don't like this is the fact of it, is Trump has a little bit better relationship with the Saudis.
Yeah, there's no question.
So if oil gets out of control, he might be able to, let's call a spade, strong arm them a little bit into getting the oil prices or the production a little bit higher. And they could turn on the faucet.
They could easily turn on the faucet. Listen, and if they really wanted to, they could turn on the faucet so much it caused oil to collapse.
Yep.
Because look, oil could trade at $10 a barrel and they'd still be making money.
Fine. Yeah.
Right? We'd be hurt, which is actually, by the way,
what they did.
What happened the last time when oil traded well below. All the U.S. oil producers were getting smashed because oil was trading at $20 and $30 a barrel.
Yeah.
Remember? The Saudis were happy. They'd rather see it trade at 80 or 90, for sure. But the Saudis have no problem turning on the production.
All right,
Yeah, but that point about being the swing producer.
I know that there's some schedule issues.
Yeah,
The
there's
last time
some
we
other
got
people.
wrapped.
But
Now,
the thing
I
about-
still have the scars when it happened last time.
The thing about the swing producers is critical. No one else has said that today.
Yeah.
That's a really good point.
That's excellent. We have, you probably recognize her from her many appearances on CNBC and other financial networks, Katie Stockton of Fair Lead or Fair Leads? Is there an S on the end?
Fair lead.
Fair
It's
Lead.
actually a part on a boat.
What's that?
It's a part on a boat.
Is it really?
It is.
Are you a sailor?
I am a sailor, yeah, and it's the little eyelet hole that keeps the lines running free.
Okay, now we learned
Now
something.
you know.
There's the takeaway from the show. Like, where are you from that you were sailing?
In Connecticut.
Oh, fantastic.
But I sailed out in San Francisco, which is really the place to do it.
That is
Yeah,
outstanding.
yeah. It's
Here
lots
Being
of
an
fun.
Italian immigrant kid, I'm
We didn't have
that
those.
sounds like a horse. Yeah. So it's like something I would
It's
bet
a
on.
subtle nautical reference, right? I mean,
that's
think
subtle,
about what
right.
we do, navigating the markets and
So do you know who Don Wilson is? DRW? Do you know who
don't.
Don
Yeah, I know Don.
Don Wilson has a company called DRW, and he's an eccentric, and I've sailed with him before. He's a big sailor. I thought you'd know the
Nice.
company DRW. These guys are like literally like,
Can you tell me what a bosun is?
a bosun.
Yeah.
Yeah, that's the little chair that takes you up the mast. Yeah.
I don't know what it is.
Oh.
no,
friend of
that
mine
wasn't a
who
quiz. Yes.
Oh.
A friend of mine who was in the Merchant Marines, his dog's name was Bosun. I'm like, that's a
Yeah.
stupid
Yeah.
name for a dog.
It's a. No, I get it.
Yeah.
Yeah.
All right, so
He's like, no.
I'm
It's
yours.
actually
I'm
kind
the
of cute,
stupid one.
but it does. You use a bosun chair to sort of save the day on the boat. So
We should have a ship.
Suppose some of these people I think tuned in to talk about markets a little
Yeah,
bit
maybe.
too. Do you guys mind
No,
if we break from sailing? Katie's a technical analyst and a good one. Both our trading strategy is 60 to 70% technical analysis and then 30 to 40% fundamental, but it's mostly just to bolster our technical viewpoint. We never get into a trade, and we trade separately. We don't trade the same book,
Okay.
but we've known each other for so long. We never get into a trade unless the technicals give us the entry point. Don't get out of the trade unless technicals do. Fundamentals are fun for talking on air, basically. And again, I
create a
enjoy it
narrative,
because it gives
yeah.
me ideas sometimes too. But we look at the current state of the S&P, we might as well start with the good one. Okay, we make new highs, we stay above that, seems like we break out. My mind is that 59.20 level, we settle above that, any sort of strength. I think it's green light for a significant move higher. What do your technical tea leaves tell you?
yeah, I mean, listen, we use a combination of momentum gauges, overbought, oversold metrics, and relative performance metrics. And for the S&P 500 and really all the major indices, long-term momentum is obviously to the upside. And so is short-term momentum. Short-term momentum isn't what it was. It's faltered a little bit. We had from the last breakout that we got from the S&P 500, which was just above a recent high, around 5670. That breakout, which is now seen follow through, yielded a measured move objective of 5935. That's not necessarily like where it all ends, right? It's just an objective, exactly that. But it does often become like a natural place for consolidation or a pullback. So we're in this mode that we're kind of bracing for a pullback, even though we don't have a confirmed sell signal yet. So I wouldn't say necessarily better sellers except in certain segments of the market, but we are not really willing buyers right now.
So you mentioned the objective. I use measured moves a lot with some of the technical patterns I followed. And I use the word target instead of objective, right? But I always tell people that a target is not necessarily where you cover a trade. It's where, as an active investor, it's where an action is needed. An action is called for. Whether for some strategies that means you add to your position because you're adding the winners, some you take part of it off, some you adjust your stop to get it tighter. When you're looking at equities specifically, do you believe that equities have a natural upward bias? And based on that, when you have a sell signal, is it more like a lighten in the position, or is it more like a getting short, or you don't make that assessment?
Yeah, so a couple questions in there that I'd address. So first, in terms of sell signals, those aren't necessarily indications to get short. So we are really averse to shorting stocks at new highs. Just as a general rule, it's usually a bad idea, right? Because new highs are showing that there's been momentum, often also relative performance. The way we're using the measured moves is a little bit different, but also it kind of achieves the same end, which is for a sense of the risk-reward relationship before taking a trade, right? So we're looking at the upside potential to the measured move objective, and then we're basically relating that to the support level that we're comfortable using as a stop loss, if you will. And that ratio becomes, okay, is it worth it? Is it worth us either publishing on this idea or taking it ourselves?
So is it fair to say then when something is making new highs, it's more likely to make another new high from a probability perspective?
So to that question, yeah. So the uptrends we're going to almost always assume will remain in force until they really prove us otherwise. And that's going to take more than a daily MACD sell signal. It'll take something that impacts at least the intermediate term gauges, the weekly indicators, and also the monthly gauges. We want to make sure that we're really eliminating noise when we're analyzing these trends and not getting too caught up in a pullback, unless it's somebody, that comes to us and says, well, we're looking for a good exit in this stock, we've held it too long, then we might be mindful of a pullback, that type of thing.
So you mentioned sectors a second ago. When you look at the way we've traded the last 2 years, so much heavy lifting is done by 7 stocks. Now, when you look at those particular names now compared to, let's say, the Russell, because I was of the belief that there was a lot of positioning short Russell long the Mag 7, although I think probably some of it has been wiped out now. Mm-hmm. Do you have anything you look at sector-wise that looks technically much more attractive than anything else?
Well, it's been an interesting environment sector-wise, and this is the stuff of our ETF, which is called the Fairlead Tactical Sector ETF.
Fairlead Tactical Sector ETF.
TAC, T-A-C-K, another
sailing
nautical.
You just reminded me of a prosecutor from My Cousin Vinny.
Got it.
This is what you should be listening to. TAC, like the sailing term. Anyway.
So we obviously spend a lot of time on sector rotation, and we believe in a way that it's like the low-hanging fruit from the market, because the dispersion on the sector front year over year is just massive, right? Even in the S&P 500. So we watch it very closely, both in absolute and relative terms.
So what's the low-hanging fruit? The Russell, the small caps?
It's just the rotation in the market.
Okay.
Yeah, so as a strategy to try to leverage that, any given year, there will be a sector that's up 50% and then a sector that's flat, or vice versa. So it's really wild to see how different they can trade. With that in mind, we've had some real rotation of late. Now, we've had an environment up until this summer that really was technology sector led and mega cap sector or mega cap heavy sector led. And that's changed. That has changed in our relative strength ratios and their momentum. And it has changed in our relative rotation graphs, or RRGs. I don't know if you've seen those. Very helpful. Taken together, they suggest that we'll have more defensive rotation, because the ones that are like bringing up the rear of that rotation are indeed defensives, like utilities and real estate. Healthcare even is emerging. So we've had some real rotation already that is more defensive and should continue.
So you mentioned utilities. Do you do any work as far as utilities and the dividends they pay compared to Treasury yields, compared to Fed funds yields? Do you do work on that? Like, do you get into those weeds too?
I think it's more of like an acknowledgement that utilities should outperform during an environment. Yeah, right. So it's just an acknowledgement of those macro forces. And then what we do with and I call them macro technicals, we'll look at anything that influences equities, but we're going to look at them as a standalone. And honestly, my hope is then the narrative will fit. Right, so we're going to look at Treasury yields as just Treasury yields, not as what is the dollar doing, what are equities doing, not what is the Fed doing. We're going to just look at the trends in yields, and then hopefully it makes sense. It makes sense from a macro perspective and can help you trade the right sectors at the right time.
Okay, so I was going to ask you a question, but you sort of answered it, so I'm going to ask it a different way. The only time you ever see equities making new all-time highs and gold making new all-time highs is when there's latent inflation that may develop and the Fed's not fighting it.
Okay.
In looking back, that's what I've always seen. When I've seen these two going up together, people think gold's an inflation hedge. It is only when the Fed's not fighting the inflation.
That's interesting.
Right? So I look at it and I say to myself, okay, I don't think correlation's a trading strategy. I'm talking to both of you here. I think it's a terrible trading strategy.
I would agree.
I used to have people say to me, well, gold's going up, so I should buy oil companies, and be like, well, it's 100%, crude oil. And I'd say, it's 100% correlated to crude oil? Crude oil. So if you believe in crude oil, buy crude oil, don't buy Exxon, right? It says to me that one of them needs to reverse, unless inflation continues higher and the Fed does keep rates lower or even go lower from there. Mm-hmm. Do you see anything in your analysis that one, either gold or equities, is weaker than the other? And I'm not going to trade it, just for anything. I'm not.
Without question. And I agree with you on the correlations point. We acknowledge the correlations. We're interested in knowing what historically they have been. But we also know there's long durations of just dismantling of those
Yeah, they break down.
They completely break down. And I'm quite sure it is because of macro forces, which we're not really privy to necessarily. And there's just so many moving parts. So we acknowledge it, we're interested in knowing it, but we don't trust it as an investable sort of indication. And I think the gold equities relationship, that makes sense to that end as well. So what we're seeing in gold, you saw a massive trading range breakout, good upside follow through. So we're approaching the measured move objective, which you probably know is 2,070 or 2,755. Yes, yeah. Within dollars. And so it's getting pretty close to that, but we have no big sell signals, and that's
in either one.
Well, no, we do in the equity market. So for the S&P 500 and NASDAQ 100, we have short-term signals we can contend with, but it's the long-term signals from the DeMark indicators that differentiate right now gold or precious metals and the equity market, and saying that the equity market of the two is technically more overstretched.
So Jimmy and I both still do financial television. We don't go on CNBC anymore. We like to say it was our choice. No, yeah, that's fine. I don't remember where I was going with this. But no, he's like, don't say that, don't say that.
No, I do.
No, no, just from that perspective, like when I go on, one of the things that I always said to people sort of privately for years and years and years was when a producer said, hey, we want to talk about X, Y, Z. Just happened to me the other day. We want to talk about Netflix coming with their earnings next week. Like, well, I don't really have an opinion on it, so I look at a chart, and then I make up the fundamental opinion based on what I think is. Yeah, I back into it.
I think it's a very valid way to do it.
I do too, because like if I had that situation when Chipotle had the E. coli thing, I wanted to buy it. I'm like, I drove by that one Chipotle that's on Madison, I think it's Canal in Chicago, and there was a line out the door the next day. I'm like, oh, I gotta buy this stuff.
Wow.
And a technical analyst that Jim and I are very good friends with, Mike Arnold, who's another great one, he said, you can't buy it yet. You can't buy it yet. He said that to me for like 2.5 years. And he was right the whole time.
Yeah.
So
fighting the trend.
Yeah. Do you ever see that as sort of a secondary thing with clients, where clients are like, I know you have a measured move, but what do you think?
Yeah. Fundamentally, they know to not ask me that question, because I'd have to harken back to like my finance 101 class in college, right, to get there. That's because I've really honed in on this expertise. But I do believe that technical analysis is like the ultimate complement to fundamental research, right? And I also believe in, if you can, you start with your list, you whittle it down technically so that you have a far shorter list to analyze fundamentally, because honestly, it takes a lot more time, right? To understand a company is much different than understanding a price chart, right? A price chart, you have so much more capacity to understand it. How long does it take you to have an opinion on a
When I'm looking at a price chart?
Yeah.
10, 15 minutes, tops.
Tops.
And this is where I think, like, I'm actually going to push back against it's complementary. I think technical is the only thing that we can know to be true.
Well, it is.
See price action.
It's all of the, sort of decisions to be made are boiling down into the stock price, right? But with the trends, there is a driving force behind them long term. And that's where I think the fundamentals and the macro work comes into play, where it's like, you should know what the cash flow trend is. You don't have to get too crazy with it, but I think just to have it
worship
general.
at the same altar as you.
Yeah.
Will you come on one of our shows and do a 45-minute breakdown with us? If you say it, you're committed to it. These people
Am I on tape?
watching. You are on tape and you said it. Otherwise, you're a liar. Thank you guys for joining us again. As always, none of this works without your support. Thanks for the DMs, the retweets, all the support you give us. It's humbling. Thank you for joining us. A special episode coming to you from The Money Show in Orlando.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.